Welcome back to It's Only Money with financial advisor Scott Brown of Edgewater Family Wealth. Edgewater Family Wealth is a website if you want to get Scott's book. It's called I've Never Made Anyone Rich. You can find that on Amazon. And to contact Scott, you can either go to the website or call 407-648-1881. His right-hand man is here, Tammy, as well. Good morning, gentlemen.
Good morning.
Good morning.
Tammy, freshly shaven. I almost did not recognize him.
He'll have that beard regrown by the end of the show.
Yeah, exactly. I saved it yesterday, and look at me now.
Wow. Yeah, it's a powerful thing. What a beard can do. People who don't have beards they always tell you like, I'd love to have one, but I just can't grow fresh. Like I got a patch right here and patch right here, and you now know the full story of their face.
Yeah. That was more information. It's funny because let's be honest, we were just talking about mustaches.
Yes.
And how we feel like the biggest problem in this country is that we don't have a president with a mustache.
Yes.
Because the last one was Taft, which, arguably was a mediocre president because he followed Teddy, and that, everybody was going to look a little bad following Teddy. But
and his big claim to fame is not the mustache even, it's the falling in the bathtub. Isn't that him?
I feel like that's right.
Yeah.
Yeah. He was not.
I know nothing about the man's policy. I know he was stuck in a bathtub once.
He got stuck in a bathtub and he had a mustache. We know that. And I feel like that's all we need. That's the recipe for success in this country.
Absolutely. Like we need like a mustachioed person to just be at some kind of high level of any political office. You pick the one, but like there's just none, and I don't know if I trust it.
Yeah, I mean, if you can't, I think the critical part is being able to twirl a mustache.
Yeah.
Because if it just oozes credibility if you can twirl a mustache.
Yes, but you have to twirl both, because if you're just sitting there twirling one, that makes you an evil villain.
Yeah.
And well, I don't know. That's our that's our current problem half the time.
Well, yeah. That's been the problem the last few, I think. But anywho, we digress. So I think it's time for
Numbers.
Numbers with Tammy. Numbers with Tammy. Numbers with Tammy. Working on it.
Wow.
He hit all of the octaves, all of the bad octaves.
He keeps being impressive every time.
Absolutely. It's been an interesting week, though, so I'm excited for these numbers.
Yeah, let's get right into it. So, Tammy, what exciting numbers do you have for us today?
So I thought because of the positive earnings that we've been having the past quarter, I thought we could take a look into how the sectors are doing in general year to date.
Different sectors of the market, meaning like industrials, transportation. What are you talking about?
Exactly. So economic sectors in the equity market.
Yeah.
There will be materials, consumer staples.
Yeah.
That will be your energy and all that.
Yeah.
Want to see the performance of these and then understand how that happened.
Ryan thinks consumer staples are what are in that thing on his desk where he puts paper together.
Yeah, it's next to the consumer hole puncher and the consumer paper clips.
Those are the key sectors we're going to be looking at.
Of course, they are. Yeah.
You can learn a lot from an Office Max.
Definitely. Paperweight. That's a staple. Yeah. And just to follow up on that, staples are things that people are always in need to, like your toothpaste, your toilet paper, your basic food, Walmart stuff that you look into.
Right.
And for that, I looked up energy, for instance, to see how we've been doing on year-to-date basis. We're almost 60% up year-to-date. Now,
what does that mean?
That means that the aggregate price performance for all companies in the S&P 500 year-to-date has been 60%.
Wow.
Yeah, impressive.
So you're talking about the earnings in those companies.
No, I'm talking about the price performance.
The price performance, yeah. So we all know the price at the pump has gone up considerably. You ask anybody and they'll complain to you about it, as if I had something to do with it. Now, if I had a mustache, that wouldn't be.
I actually printed out a bunch of stickers with your face on it, pointing that says, "I did that."
I did that. Brown. Scott Brown did that. Yeah, that'd be awesome. All right, so energy's up. We know that those companies are making a boatload of money right now, which they're not unhappy about. They will pretend they're unhappy about it, but they're certainly those guys are one side twirling mustache guys.
Oh yes, they are.
Yeah,
only one.
Yeah, for sure. All right, so energy. What else do we got?
We have the utilities also 5% up year to date.
Wow, interesting.
The rest are all negative.
Is it fair to say that utilities in a time of crises or a time of economic upheaval, utilities are typically, of course not always, but typically a safe haven, a place that does better when things are not going well?
They are defensive.
Yeah.
They have good dividend payout.
Right.
And they usually don't fluctuate a lot with the market.
Because we all need power.
Of course.
And water.
On water.
Right, right. So those are consistent. All right, well, that's cool. What else?
Now, interesting fact about this, although energies are 60% up, but did you know that on a 20-year, when you look at a bigger frame, energy is 400% up, but that's 20 years. So if you invested, say, 20 years ago in the sector, your money would be 400% up.
So if you put $100,000 in 20 years ago, how much would you have?
400,000,
right? Mm-hmm. Okay, so that's not terrible.
That's not terrible, but it's not nearly as good as the rest of the sector.
What?
Yeah,
I did not know that.
So
Go on.
For example, information technology is 1,000%.
Whoa.
So that's more than double.
Yeah. So IT, Amazon, Google, Microsoft, Apple, et cetera, et cetera. Speaking of which, we talked a couple of weeks ago, Ryan, about people selling their mutual funds or their stocks or whatever, thinking this is it, the world's going to end. We're going to be living in caves and growing corn and shooting at each other. Thankfully, that hasn't happened yet. Thankfully, but one of the points I made at that time was, if you took your money and put it in a CD, for example, something guaranteed, and you get 1% on it, you're currently down 20 or 30%, which some of those stocks were. It would take you the rest of your life to get back to even. You'd feel good. You go to bed at night and go, it can't go down anymore. But you ain't getting back to where you were with that strategy. To that point, how much literally in the last couple of weeks have those two stocks? 'Cause remember, the average CD rate in this country is around 1% or less.
Yeah.
1 or 2 year CDs. Don't quote me on it, but it's in that neighborhood. It ain't good. Let's put it that way. What did we earn on Microsoft and Apple had we held on to them over the last couple of weeks?
So Apple 2.7, about that much.
In 2 weeks.
In 2 weeks?
Yep.
Microsoft is 3.6.
In 2 weeks. Yeah. Salesforce. You and I are big Salesforce guys.
Yeah.
What did Salesforce earn over the last couple of days?
Oh, yeah.
It's up over 10%, right?
Well, yeah.
Yeah.
Near 20%.
So Ryan, if you own Salesforce instead of meme stocks, just saying.
I also own Ford.
Well,
which was a meme stock for a moment.
No, I don't think so.
It was. No, on Reddit, like the 4 stocks that you were like buying if you were like a crazy person was AMC, Clover, Ford, and GME. So I bought Ford, and then it went crazy high, and now I've lost all my money.
Yeah, but it's coming back. It'll come back. I'm not worried about Ford. So the point was, these good stocks, what I think are good companies, because we always get caught up in good stocks. What's a good stock? Well, what does that even mean, right? These are just symbols for the companies they represent, right? So if you believe Ford's going to sell a boatload of F-150s, these Lightning F-150s, which I do, I believe they will. They're like back-ordered at this point. Ford's a good company. They're not going anywhere. Are they going to have a bad day? Sure. Have they had a bad day? Sure. But the reality is, that stock was like $20 before the market started down a few months ago, and it's $13 or $14 now. But it got down to 12 and some change, and now it's bouncing back. My point is, if you take I'm going to take my ball and go play somewhere else, hide under a rock strategy, you can't get the money back as fast, if ever. I would argue some people back in 2008, 2009 got out of the market for good. They're like, this game is rigged. I don't want to do this anymore. I don't want to play. It's only for rich people, et cetera, et cetera. They get out in 08, they get out in 09. Their 500 turned into 300. They got out. They put the 300 in the bank, and guess what it is today? 310. Now, had they left it alone, that 300 would be 800 or 900 right now. So again, it's one of those situations where if you're disciplined and you're patient and you understand the dynamics of the market and you embrace volatility and you say to yourself, if it weren't for the volatility, I would not get the returns that I seek, right? Because if it's a steady uphill climb, that's called a CD. That's called a savings account. They never go down. That's the good news. The reality is, though, you're not unlikely to grow your money beyond the point of inflation, especially today, right? So everybody's complaining about inflation. Oh, inflation's this, and gas is that, and eggs are this, and toilet paper's that, or whatever they're beefing about, because people always got something to beef about. They're the same people who want to get out of the market when the market is literally their only chance to stay ahead of inflation, right? And I mean, bond prices are getting a little goofy, and I think that represents some opportunity. And you say, well, I remember the days when rates used to be 8% or 9%. Yeah, well, inflation was 12. So again, be careful what you wish for. So anyway, I digress. What else you got for me?
That was a great point.
It was a good digression. Yeah. Thank you.
Not all digressions are necessarily bad things.
Fair enough.
So it's so funny though. So when I first got a bank account, right? I saw CD on the wall, and I'm like, it gives you the, I'm like, I'm gonna do that. I could throw money in a CD, and I literally pictured me buying a physical CD.
Yeah.
And when they didn't hand me anything,
you were annoyed?
I was like slightly annoyed and very confused. So while we have 30 seconds left, what is a CD?
So a certificate of deposit is something you purchase from a bank. It does not. What year was that you made this?
In 2005.
So I don't know who the musical act would have been in 2005.
Probably Nickelback.
Yeah, so you didn't get a Nickelback CD for that, which is a somewhat ironic statement in and of itself. But a CD is a certificate of deposit where you get a set rate of return for a set rate of period, and they promise to give you your money back.
Nickelback CD, bad investment, I'll tell you that. But we'll be right back with more It's Only Money. Welcome back to It's Only Money here on Real Radio 104.1. I got Tammy and Scott Brown from Edgewater Family Wealth. The website again, edgewaterfamilywealth.com, and you can get Scott's book on Amazon. I've Never Made Anybody Rich. Is it anyone or anybody? I feel like I go backwards in my head.
Anyone or anybody. What did I say? Anybody?
I've never made anyone.
Anyone. Is that improper English?
I feel like it's a trick because then you're like secretly, I'm going to open up page 1. I'm like, never made anyone rich.
Right.
I made lots
of people rich. I hadn't thought of that, but I'll put that in the next book.
Yeah. We still got to talk about the title of that next one because I don't think we should let you be in charge of it.
Probably not.
But yeah, we were doing the numbers when we got done, and I figured we'd come back to that. Because here's my question for you, because you said energy's up, you invested, it's up 4,000%, 400%, 400%. But people aren't using energy any differently. It has its ups and downs, so it goes up 400%. Me right now, should I move my from my meme stock to the energy sector?
Of course not, because that train.
Wait. That was a trick question.
Well.
Because that would involve him keeping the meme stock too.
Oh,
so
no.
It's really frying pan or fire for him.
Oh my God! No, I totally missed that.
Yeah, he totally tricked you on that one.
I'm so upside down and underwater. I'm right side up and in the air. Like
nice.
That's where I'm at.
My head just exploded. Yes. But anyway, so
I'm twirling my mustache.
So yeah, only on one side. So the point we digress again. So the point, the question is, if I'm looking at energy and I'm saying it's up 400% over the last 20 years, and in fact, most of that, Tammy, if I'm not incorrect here, it has come in the last few years. Yes.
Yes, actually, the last year.
Yeah. So I mean, this is what people do. They're going to hear this or they're going to see this somewhere else because it's out there. You read the journal, you're looking at Barron's or whatever you're looking at, you're watching the news one night and you see that Shell or Exxon or I don't know what other energy, Marathon, whoever it is, BP are up 30, 40, 50, 60% this year. And you say, wow, look at this. Look at what I've discovered. I've discovered that these stocks are up, right? Because that's all you've discovered. You haven't discovered anything else. These horses are out of the barn and running through the field, and you're like, look, the horses are out of the barn, right? Well, that's helpful, right? At this point, it's too late, yes? So
it is, yeah.
You want what people want to do is to say, well, that's a pattern, right? It all comes back to recency bias and pattern seeking. Our little reptilian brains think, look, I've read in the paper or I've heard on the It's Only Money show that energy stocks are up 60%. I think they'll go up another 60%. Why do I think that? I have no idea. But it seems to make sense in my little reptilian brain. So the point is, should you buy energy stocks? I don't know. Maybe they'll go up another 40%. Who knows? But the reality is if you're buying them because they have been up and you believe you've determined or you've found or discovered a pattern of some kind, that is not correct. So knowing that that sector is up 400% for the last 20 years, but knowing most of that came in a very short period of time, which is more recent, you know that that's a very volatile sector that gets a lot of its growth in fits and starts. We're in a little bit of a start now, but the fit could be coming. So just be wary of buying high and selling low and overreacting to recency bias.
Absolutely.
So you can't keep your AMC.
That's too bad.
Yeah.
I'll keep my eyes open next time. For that.
Yeah, it's so funny because like I'm trying to. I've listened to Scott and he says you hold and you wait and the things are going to turn around, but ooh man, that's a lot of red on the old app trading right now.
Yeah, and that should be and so what you should be thinking, I think, is that what are the opportunities in my portfolio, right? I own all these stocks. I own 10 stocks, 20 stocks. I own a mutual fund, whatever you own, and you say, all right, well, I've got all these companies. Some of them are down 10%. Some of them are down 30%. Do I like these companies? And if I do believe these companies are going to be around in 5 years or 10 years or 30 years for that matter, should I be buying them at a price that's 30% less than when I bought them the first time? Well, the answer should be yes every time. If you've determined these are good companies that are going to be around. Now, if you bought, Peloton's the example that comes to mind right now, and I'm not even sure that's a good example. If you say, well, I bought Peloton because of COVID and everybody's in their house and they were stuck and they were exercising and they had their new friends on the Peloton and they were doing this thing and Peloton shot up and they were getting like $5,000 for one of those stupid bikes, and now that's not so true anymore, and people are getting out of their houses, they're riding their bikes outside, they're going for walks, they're doing whatever they're doing, and now they're selling the bikes for like $2,000 or something. I don't even know, but it's a lot less. And you say, well, maybe that was a mistake. Maybe fundamentally that company, not the stock, let's forget the stock. The company is not as good a company as I thought it was. Now, some people would make the argument, and I think fairly, that Peloton might be a takeover target for a Nike or an Apple or somebody like that, and I can't argue with that. That may be true. So, even in that case where you say fundamentally this is not a good company going forward, but if they were merged as part of Nike or they were merged as part of Apple, and I'm not saying that's going to happen or not going to happen, but as low as the stock price is, it's certainly likely to happen. Mm-hmm. Somebody will scoop them up and do some branding with them and develop that into a segment of their business. The point is, which I've gotten away from, is if you have good companies and they happen to be at a lower price, how can you say to yourself, no, this is not a good time to buy? This is a good time to buy.
I'd agree, yeah.
Now, how do you say what a bad company is? Is it do like negative like news reports on it, like that's a bad company? I know you've talked about before these apps that people get where they can pay later for things.
Oh yeah,
yeah.
Which essentially, like, to me sounds like just a credit card but on your phone, but somehow it's fundamentally different.
Yeah, I don't think so. I think it's a problem. These companies, like I think Afterpay and Affirm and Zip, these companies that young people, I think, typically have on their phones, where they go into a retailer like the Gap, or I don't know where people shop anymore. But anyway, I assume there's still retailers out there.
There's still a Gap.
There is still a Gap? Yeah. Okay, good.
Montgomery Ward.
Yes. Sears and Roebuck. Get me some Tough Skins. Anywho, that when they go in, we know that they purchase 40% more goods with an Afterpay type app, right? They're spending more because they're not feeling any immediate responsibility for the purchase, right? So you go in to buy some clothes. You're like, listen, I only got $200. Oh, but if I use this thing, I can spend $300. The key part of that was you only have $200, right? Now you've gone into debt in a very easy way. There's no obstacles for you, so you do it. And so talking about business models in companies like Afterpay, who was just acquired by Block or Square, whoever they are called now these days, I mean, these companies are getting their heads handed to them right now because defaults are up like 400%.
No.
And you know what? Good. Because the reality is this is very bad for our young population. It's just another way we're tricking them into debt. These retailers and these credit card companies. When I was young, it was a credit card. I told the story on the air. Sent me my credit card. It was $500. I was the most excited guy that ever lived at 19 years of age, and I bought beer for everybody in that damn bar that night. And then, like 7 years later, I was still paying off that $500. Right? So
expensive beer.
Yeah, it was very expensive beer, and oddly enough, I don't remember that night. But the truth of the matter is that this is a very dangerous game we're playing with these companies. And then you have to say to yourself, all right, well, the defaults are up 400%. Maybe the shine's off of this. Maybe this business model isn't as great as I thought it was. These companies are losing money, right? And that's okay. Sometimes companies lose money, and they're still good companies. Amazon lost money forever. Tesla lost money forever. I mean, these are even Apple lost money in the beginning. So that's not necessarily the sign of a bad company. But if you see I don't want to say ethical or moral, but issues with a company that seem like they can't overcome them with tightening up the balance sheet, that's probably a good sign you want to be somewhere else. And something you understand, going back to the conversation about Peter Lynch, who is arguably the most successful mutual fund manager of all time, he would say, do not buy anything you can't illustrate with a crayon, meaning he would follow at that time, his daughters through malls. I don't know that that's a thing anymore, to see where they went, see where they shopped, see what they bought. And if he couldn't understand, the methodology behind their purchasing, then he didn't buy the stock, right? But if it made sense to him, if he went, his head turned to a new car from Ford or GM or whoever it was, that's how he processed information. He didn't say, look at the potential earnings, he looked at some of that stuff, some of that fundamental stuff. For him, it needed to be simple. Let me understand this. And if you don't understand it, don't invest, period. And you might miss out on some stuff. I'm in that category. If I don't understand something, I don't buy it. And the truth of the matter is there's some things I didn't understand that made people a lot of money. I'm okay with that.
Yeah, good. Well, yeah, you're not losing tons of money either that way.
Right. I think you avoid more mistakes than windfalls. You're not missing out on a bunch of windfalls, I don't think.
Yeah, and the windfalls are, correct me if I'm wrong, but fairly rare.
Very rare.
But losing money opportunities, fairly common.
Very abundant. There's lots of opportunities to do dumb stuff.
That's actually the name of my book that's on Amazon. It's Ryan Holmes, Lots of Opportunities to Do Dumb Stuff.
That I've already done.
We check that out. And you can't find Scott's book, though, which really does exist. I've never made anybody rich on Amazon.com. And it's on Kindle. If you got the Kindle subscription, you can read it for free. How nice is that? Did you know that, Scott?
You're welcome.
Now we just need the audiobook from you.
Yeah. I don't know who I'm going to get to. I want like Morgan Freeman or somebody to read it. Everybody wants Morgan Freeman to read their book.
Yeah.
That would be very cool. But they do, if you want more out of the show, go to edgewaterfamilywealth.com. They have a content library there. You can find past shows, all the YouTube stuff, and lots of different stuff, including Tame's got a section on there. And that, personally, my favorite section.
Mine too.
Yeah,
absolutely mine too.
So check that out. We'll be right back with more It's Only Money here on Real Radio 104.1. Welcome back to It's Only Money with financial advisor Scott Brown from Edgewater Family Wealth. The right and left hand man, Tammy, is here as well. Both hands on the financial steering wheel. That's how we do it around.
Somebody's got to drive.
Exactly. But this is the longest numbers with Tammy section that I've ever seen.
Because I feel like he did that intentionally. Like he's trying to get more airtime.
Yes.
He may be making up these numbers at this point.
Wait, no one is fact checking Tammy.
No.
Yeah, my plan has been foiled.
Do your research. It's all a conspiracy.
It's literally what he does is research. Wait a minute, what?
Bread and butter.
Yeah. But we didn't quite talk about earnings just yet either.
Oh yeah. So we looked up earnings for the past 2 weeks to see some of the big names out there, how they're doing in terms of revenue and earning per share.
Yeah.
Despite all what we hear on the economy, there's something people talk about that we don't know. Recession here and there. We hear those words just to see, and this is part of the due diligence we see whenever we want to invest in a company, or we have a position, a portfolio, and we want to
due diligence?
Yeah.
We do due diligence?
Yeah.
I thought you were supposed to just read it in the paper and then buy it. That's not how that works.
Is that not what you guys do?
Yeah. Or when your friend tells you.
Yeah.
That's the best research.
Yeah.
Magic 8 Ball.
On the internet.
My cousin said.
Yeah. I just assumed that you guys have like a lot of just hot stock tips that come in from wherever, and you're like, yeah, that sounds good.
We spin a big wheel every day.
No, but you guys do. You do the research, you do the analysis. Tammy's iPad is basically smoking at this point with the amount of research that he's done.
Yeah. All right, sorry, we interrupted you. Go ahead.
I'm lost now.
Yeah. What were we talking about?
So earnings, one big name, Home Depot, right? Their earning went up from 3.8 to almost 4 and something per share, 4.1.
Yeah. So they're making money.
They are making more money.
Yep.
We're talking about $37 billion last quarter and $39 billion
with a B.
With a B.
So Home Depot's doing well.
Very well.
Okay, who else?
Salesforce is doing well.
Yeah. A lot of people don't know what Salesforce is. That's a big CRM
system
that companies use to keep track of their clients or patients or customers or whatever. It's how they track their behavior. It's actually an amazing company, and I in my opinion, run by a great leader. So I mean, I think that's the stock we were just talking about that was up 10%. Not again, now everybody's going to run out and buy CRM. Don't do that.
Yeah.
Don't do that. That's not my point. My point is that's a well-run company that is also doing well. So I think that would have been a good stock to buy down on, say, 2 weeks ago.
Exactly. Yeah. Other big names like Target, Cisco, Best Buy, NVIDIA. Technically they're all doing well when it comes to earning, and earning is part of what we call the fundamental analysis that what we do. And this comes on every quarter, but we try to look at the numbers themselves and see based on that whether we want to trim a position or increase it or etc. if it matches the criteria that we have.
Yeah, so I think it's and that's part of an interesting discussion in so much that we could do all that research, which we do. We have spent a great deal of time and money on that. But if the market is doing poorly, if the market is down 500 points today, no matter how much research we do, those stocks are likely to be down. And
Absolutely.
And statistically, and so it's not to say we shouldn't do that, because that's our little bit of an advantage, is to understand a few more nuances than maybe somebody who gets their advice from the internets. Interweb, sorry. But the reality is, statistically, we know about 90% of a stock's movement is attributable to the market, meaning if you have a good stock and a bad stock and the market's up 10%, both of those stocks are going to be up.
Yeah.
If the market's down 10%, the good stock and the bad stock are going to be down. So, getting too caught up in the other 10%, which is sector. So like you would say, well, energy is bucking the trend right now, right? So that's another 5% that we would attribute to the fact that that's in a hot sector. The reason that's a hot sector is because Putin's invading Eastern Europe. We've lost 12% of the world's oil supply to some degree, which has caused prices to spike. I know everybody has their own theories on why gas and oil are more expensive, and I'm not going to get into that right now. But the reality is that's a factor for sure. So I think it's important for people to know, no matter how much research, quote unquote, you think you're doing, if the market's doing poorly, you're likely to do poorly as well. Another 5% comes from choosing good sectors at good times. So if you'd have bought energy last year when it was down, or 2 years ago when it was down, you would have benefited from buying low, yes? It is no longer low. I think the remaining 5% comes from the individual company itself. Maybe they got a new product or a new drug or new whatever, new widget. And that's hard to know. It's hard to know that's coming. It's not like, a company that's going to come out with some new innovation even knows if it's going to work, right? You couldn't know that ahead of time. What you could know is a good company with a good research department that has a long history of earnings, blah, 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 blah. So the fact of the matter is we do a lot of research, and we do look at the fundamentals, and we do look at earnings, and we do look at sales, and we do look at cash flow, and we do look at all those things. But at the end of the day, we are somewhat driven by how markets do overall, which I know is not an exciting, sexy story, Ryan, but those are the facts.
Yeah.
And facts are boring.
They are. Nobody likes
I'm
facts.
trying to tell you not to use them, and go more clickbaity every time. But you and your facts, man. What you say that the things that you do look at? What do you think that you don't look at that somebody who doesn't know what they're doing does?
Recent price history.
Price
I'm not
history.
saying we don't look at it at all, because there is momentum, there is something to be said for that. But I don't spend. Tammy will tell you this. The only time I look at recent price history is if it's way down. So if I see a stock, I may be somewhere and I notice that XYZ is down 15%, and I'm like, well, that's a company I like. Why is it down 15%? And if I can't come up with a good reason, I'll send him a text. Hey, I need you to run the numbers on and actually, Salesforce is a good example of that, yes?
Yeah.
I sent him a text that said, hey, let's look at this stock. I don't understand why it's down. Doesn't make any sense. It was down because the market was down. But it's a great company that has outstanding earnings going forward. So I said, hey, let's take a look at this. And we don't get it right every time. For sure we don't get it right every time. But that's what I'm paying attention. The only time I care a whole lot about price is if there's been a major downturn or a major run that doesn't make sense to me. And that's when I may consider recent price history. Otherwise, we're just looking at the fundamentals of the company, the overall vibe or story. We go back to Tesla. Tesla's a story stock. If you looked at the fundamentals on Tesla, nobody would buy it. right? Because compared to its peers, Ford, GM, whoever it is, Toyota, Nissan, I mean, they don't sell near as many cars. They don't make near as much money, but the stock prices, the market cap is 4, 5, 6, 10 times bigger than some of those companies. That doesn't make any sense fundamentally, but the story makes sense. The story makes sense that Elon Musk is trying to change the world when he's not tweeting. He's trying to, Boring Company, go to Mars, rockets, the whole 9 yards. It's cool. It's a cool story, and we need innovators like that to get behind it. And I think that's essentially what we're doing in Tesla.
So when I'm looking at my whatever stock app that I'm using, where should I be setting my view to be like a competent, good investor? Like from what it sounds like, the 1 day view is a waste of time.
It is.
Yeah.
So, but where would it be? 1 week, 1 month, 3 months, 1 year? I mean, like to really feel okay about it, because if I look at the daily thing, I've literally driven myself crazy before.
And there's nothing, and it doesn't do anything. It's like, checking the cake halfway through the baking instructions. Well, it says 2 hours, but I'm going to check it every 15 minutes, see how that goes, right? This damn cake never comes out right. So what I would say to you is, pick a Friday app. Every Friday I'm going to look at my stocks, see what's going on. If there's something that catches my eye, something makes me curious, I'll read up on it best I can, call whoever I think I should call. But looking at it daily, which many people do, and it's pointless. What it causes them to do is, I'll tell you this: if you bought a bunch of good stocks or things you thought were reasonably good stocks, and you went into a coma for 20 years. You would do very well. You would do better than if you checked your stocks every day. That I promise you. I'll bet that all day long. I'll bet any amount of money you want that the average person, is better off not looking at their portfolio but maybe once every 3 or 4 months. And then only reacting to something extreme. And even then, you probably shouldn't react. If you're in a 401k, set it and forget it. You're adding every month. Stocks are down, stocks are up. You're buying more, you're buying less, whatever over time. I mean, I have clients that I've retired who have literally 7 figures in a 401k, which is not unheard of. There's like 350,000 people in the country now in that category. And most of them have never made a single change. They bought some allocation when they went in. I don't know, that guy in the tie made me sign up for this thing. I bought it, and then 40 years later, they went, I got $1 million. They didn't do anything. They didn't know anything. They went fishing most of the time. They could care less. Now, am I advocating for being ignorant? I am not. But what I'm saying is, if you had to pick one strategy over another, Rip Van Winkle strategy is going to beat the Nervous Nelly strategy all day long, every day.
Interesting. So just stay calm. And stock on.
There you go. There's a T-shirt in the making right there.
Yeah, that'll be our first merch, and we'll
be wearing that with the market cap.
That's right.
My market cap while I'm listening to my CD.
Yes.
My Nickelback CD.
I think there's a little confusion now.
Well, you can clear up some of that confusion by going to edgewaterfamilywealth.com. They do have that content library. They got a blog there. And you can also contact them by either calling 407-648-1881 or the email address is edgewaterfamilywealth@raymondjames.com. And we will be right back with more It's Only Money on Real Radio 104.1. Welcome back to It's Only Money with financial advisors Scott Brown and Tammy with Edgewater Family Wealth. Again, edgewaterfamilywealth.com is the website to get a hold of them, to work with them, and the number 407-648-1881. And before we left off, I gave you the email, which is edgewaterfamilywealth@raymondjames.com. And we do have emails from various listeners here to the show. Scott?
Do you have an email song?
I don't have an email song. And a lot of our emails, weirdly, are from an AOL email address. So
that says something.
I feel like some of y'all need to upgrade a little bit.
Yeah.
Okay?
Mm-hmm.
Get Gmail, at least. But I don't want to judge people on that because they do have serious questions. And the first question comes from Steven, not Steve. Steven.
With a P or a V?
With a P.
Oh, that's the fancy kind.
That's the fancy Steven, yeah. Like I can tell when they say their names.
Does his last name end with something the third?
It does not.
Okay.
But Steven is out of Ocoee, and he said, I'm a small business owner, and I've been thinking about working with a financial advisor. What is that experience entail?
Well, it entails a lot of things. That's got a lot of tentacles. So and it's actually my favorite kind of client. Entrepreneurs are absolutely my favorite people to work with because it's not one-dimensional. The money part and the planning part is kind of one dimension, but for them, there's a lot of dimensions. There's tax deductibility. If I put $1 somewhere, where's the best tax benefit? That's true of most people, but especially true of entrepreneurs. There's cash flow planning. I have an entrepreneur, literally, I think Monday I'm going to meet with, and our whole goal of that conversation is how do we cash flow the next funding of his investment part of his business. He needs to fund some research. He needs to fund some sales. It's a new company, so looking at his portfolio of stocks and bonds, looking at his equity in his house, looking at a variety of things. All right, where is the best place for us to get money from to fund this endeavor? How much money do we take out? What's a responsible amount? We don't want to get too far out over our skis with debt. So how do I borrow money or use my securities as leverage? How use my house as leverage? What are the most responsible ways to do this without getting myself in trouble, which also makes the most tax sense? So there's all kinds of issues from staffing to payroll to how many people do you hire? Where do you cut that off? Do I go over 50 people because that brings health insurance issues into the equation? Do I want to do health insurance anyway? If so, what's the deductibility of that? If I'm going to do a retirement plan, is it a 401k? Is it a SEP? Is it a simple? Do I add the Roth? The list is endless. But to me, it's a giant canvas to paint on. To me, that's the most fun, is sitting for an hour or two with an entrepreneur and trying to decide where are my best decisions, because a really good financial advisor is really not totally caught up, or at least not 100% caught up in the stocks and bonds. To me, to some degree, that's a commodity, that portion of it. The conversation's where the gold is. And if you have the right financial advisor you can bounce ideas off of, that can be worth in any given year twice the fee or 3 times the amount of the fee. Oftentimes we find with tax implications, we can save the client 2x, 3 times whatever they're paying us. Not always, but quite frequently, just to have a conversation. So what you should expect from your financial advisor is whatever you need. They should be willing and be able, and here's the critical part, and I said this in my book, and it's somewhat critical of my industry. So there are clearly exceptions to what I'm about to say, but on average, people who call themselves financial advisors are not entrepreneurs. They are people who come to work at 9 and they do a little research, or they read the journal, they have their cup of coffee, they talk to a few clients, they go to lunch with their buddy, they come back, they answer a few more phone calls, and they go home. That's their business. And there's nothing wrong with that. Those people are useful and helpful in their own way quite frequently. But there's some financial advisors out there, and there are many in this town that I know, that are entrepreneurs themselves. So they're able to have that conversation with another entrepreneur. They have staff. They have marketing people. They have research people. They have people they pay. They're responsible for their well-being. They're responsible for their health care. They're responsible for their family's well-being. They understand what it's like to have to borrow money out of your 401k to keep people going and alive and eating while you get through a tough period of time. They understand that they had, there was a period of time when they were younger, they were building their business and they weren't sure how they were going to pay the electric bill. They get that. Most advisors are not like that, but there are certainly plenty that are. And if I were an entrepreneur or a small business person, I would work really hard to find those people.
That was one of the more interesting things I found meeting you and talking to you before we started doing the show, which was that when it was pitched to me originally, before meeting you, I was like, okay, I feel like I know what this guy's going to be. He's going to come in with his slick suit, fast talking. He's going to give all kinds of hot stock tips because he's probably getting some kind of kickback somewhere. Who knows? Yeah. And when we talked, I was like, oh, you're like a genuine person who seems to be very smart and also actually care not only about people, but for some reason you're a big nerd and super interested in all this stuff as well. And that comes off when I talk to you.
Yeah.
And I have like bros that I went to college with who've gone into the financial world, and that is not them.
Yeah. Yeah, unfortunately, and again, I'm not painting everybody with the same brush. I'm going to have friends call me and yell at me. But the reality is that most advisors are good people. They're not nefarious people. They're just limited in their experiences because they chose to do the job, right? They took a job to be a financial advisor. And in that job, they show up and, they're trying to do good by the client. I don't think anybody's trying to do anything wrong. But they want to get compensated. They want to sell. right? And then they want to go home. And that's okay because that's a lot of people are content to do that. That's not wrong. But if I'm a young business person or even an older business person who's growing a business and maybe I'm going to go from 2 million to 8 million or to 20 million or 40 million in sales, I want my financial advisor to be able to have that conversation with me in advance. This person I gave you as an example is a friend of mine, and he's a relatively young guy. He's not even 40. And he and I meet maybe 2 or 3 times a year to discuss his business. We don't even talk about I have to remind him to talk about stocks and bonds. His idea for a conversation is, hey, these are the initiatives I'm working on. If you're building a plumbing company and you have to make a hire, well, what's the best way to do that? Should I use some kind of headhunting company? Should I just hire an intern and build them myself? What would that cost? What are the tax implications? What are the cost of the benefits, right? Because if you hire an employee, for example, you say, well, I'm going to pay that employee $40,000 a year. Well, that's true, but that employee is going to cost you $50,000 a year, $55,000 a year. Because they have health insurance, they have all the taxes that go for the employer, 401k, all that stuff. People think, well, I make $40,000 a year. You could that's big deal. Well, it's not. It is a big deal because it's typically there's 20 to 30% more cost in an employee than they get in their pocket, right? So and a lot of people aren't aware of that. I'm not saying people shouldn't be paid what they're worth. They absolutely should. I believe that's the number one thing you have to invest in is people. And if you underpay people, guess what you're going to get? Underperformance. Right, so I'm more the pay them up front and see what happens kind of guy. That doesn't always work, but as entrepreneurs, the point being is if I'm having a conversation, especially with a young entrepreneur, that's exciting to me because I've done a lot of dumb stuff as an entrepreneur. I've tried and experimented with things that didn't work. They were colossal failures, right? And that's how I grew. I said, okay, we're not doing that again, right? We're going to go a different path. So to me, the beauty of the relationship with a financial advisor, at least from my standpoint as the financial advisor, stocks and bonds are cool, and I can talk about them all day long. But what's really cool is watching an entrepreneur grow their business or a young family build their wealth.
That was a really good answer.
You're welcome.
I was like, I had to stop for a second because I was like, oh yeah, I'm on the show and hosting this thing, and I was like, I just went like, yeah, great answer, Scott. So I just felt good about that. Second email I got is from a lady named Kayla out of the APK Apopka, and she says this. She says, our house just got a bunch more money to it, which I'm assuming she means her house is worth more now.
Yeah.
And my husband is saying that we need to take that money and reinvest now because if your money isn't constantly moving, then you're losing money. Is this true?
This is what's her name?
Kayla.
If your money isn't constantly moving, what was this? Then you're losing money.
Yes.
Interesting statement. So when he says take money, I'm assuming maybe he wants to borrow against the equity in their house
and reinvest in either probably another home or something. Yeah.
Yeah. I don't hate that, but I don't love it either. So what I would say is you're overthinking it. Sometimes you win by not losing, right? So we've gone through this big period where your house is worth, you bought a $250,000 house, and now it's worth $350,000. At least that's what you've been told, which that's also another interesting conversation with people. They'll say, my house is worth, I paid $400,000, it's worth $800,000. Well, what do you mean? Well, I ran the numbers and this, that, and the other, and my cousin and my uncle talked about it, and I heard then, and then got back to me, my house is worth $800,000. That's it. Well, your house is worth what somebody will write you a check for. So the reality is you don't want to get over your skis. You don't want to assume this bull market's going to go on forever in housing. I'm not saying it's going to end anytime soon, but I think having that money in the bank, so to speak, and equity in your home is never a bad thing.
All right. Well, if you want more good advice, and if you're a small business person, you're going to want to work with Edgewater Family Wealth and get a hold of them you can email them like the other people have by going to edgewaterfamilywealth@raymondjames.com. The number 407-648-1881, and the website, of course, edgewaterfamilywealth.com. Check out the contact library and all the infos there as well. Scott, Tammy, great show. Good to see you again, and we'll see you next week.
Likewise. Happy Sunday.
Happy Sunday.
This has been It's Only Money on Real Radio 104.1.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, you know, they're regular people.
Now that guy I trust. You
Yeah,
see, the problem, Scott, you don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.